This morning. Joining me now, Michael Lee strategy founder Michael Lee and Bell Point chief strategist and the Money Runner podcast host David Nelson. David, starting with you. You've got futures. Yeah, no, absolutely. And there's AGCO in the pre-market up more than 1%. Mike, big banks kicking off fourth quarter earnings. That's Friday. Goldman Sachs about to cut thousands of jobs. I hate to say this, Mike, but Wall Street likes to see job cuts. That means that Goldman, which is fractionally higher right now, could be in the news. But really quick, the Journal has a really good take on this morning. It goes, get ready for earnings expectations, very low earnings expectations. What are you looking for?
Yeah, well, look, the history of earnings is to lower expectations coming into the quarter. The company beats those lowered expectations, and everybody gives themselves a high five and a pat in the back as if they've done something well. What I'm interested to hear out of these big banks is what they're seeing on a macro level environment. What is happening to the underlying consumer? How are their loan loss provisions? Are they increasing? Are they decreasing? And then obviously expectations for the next year in underwriting and M&A and trading. I expect those to be very, very bleak outlooks. We are about to enter a massive recession. Earnings for this quarter, for the overall quarter, expectations are for a 4.1% decline. On June 30th, that was for a 9.1% growth. So we've moved up 13% in the last 6 months in the wrong direction. Earnings growth expectations for the next calendar year are 4.7%. On June 30th, that was for a 9.5% growth for calendar year 2023. I expect calendar year 2023 to be somewhere between a 10 and 15% decline, so a lot more pain to come there. Maybe we get a bounce on some of these financials earnings because, again, like I said, very low. They'll beat lowered expectations, and the guidance won't be as bad as the street is expecting. But I am not bullish on the financial sector. You're in an inverted yield curve environment, slowing deal making, slowing underwriting, and difficult trading environment because markets seem to go in a lot of unexpected directions, trending downwards. That's bad for volume. For trading, you want things to be inherently bullish. Maybe the tailwind for the next calendar year is the long end getting bid on the fixed income curve and banks profiting from that. So a lot to look for in these earnings, but I'm not expecting anything very, very good from them.
Yeah, well, I was going to say, I was looking at the expectations year over year for earnings for like Wells Fargo, 50% cut year over year. BlackRock, 24% cut. That's expectation earnings year over year. So much for all that ESG at BlackRock and that holier than thou messaging that we've gotten from BlackRock, Mike. But, really quick, I do want to ask you, just in a sense, we talked about CPI really quickly, but the Fed, we've talked about this ad nauseum, that they're destroying the economy. That is their point. They've made it clear that's what they want to do to get inflation under control. This CPI that we're expecting is going to be for the core on Thursday, 5.7%. I would argue that a 2% inflation target rate is unrealistic and doesn't make any sense anymore. Do you think there's any chance the Fed would change their mind and maybe stop hiking rates and maybe jump up their inflation target? I know that's a big ask, and I'm just a nobody, but I don't know.
I would counter that argument and say you need to have a 2% inflation target because inflation not only destroys economies and markets, it rips societies apart by their fabric. And you need to have that 2% inflation target so we do not turn into a banana republic. And the Fed has lost a tremendous amount of credibility over the last few years with their over-easing and money printing. For them to change the inflation target, not only is it not going to happen, but it would destroy any credibility they have left. I think Jerome Powell is going to stay the course. And if you look in the last inflation cycle of the late 70s and early 80s, you had a double peak. If we have that sort of situation where inflation, we just had our first peak, it gets back down to close to 2% and then ramps up again to where we saw it over the last year, that will be unbelievably devastating for the economy based on the limited tools the Fed has left in their tool belt. So I think the Fed is going to go overboard with tightening, get inflation there because we simply it's hard to put into words the devastation of a double top in inflation would do to not only our economy, but the world economy. You're talking about massive poverty, civil unrest. So no, there is zero chance they're going to change their inflation target, and there's zero chance they're going to let up early.
If this was high school debate club, you'd be winning. You would have won, and I would have lost. You're lucky I like you. No, I'm just kidding. I do. Mike Lee, very well said. Very well counterpoint made. All right. Good to see you, Mike Lee. Thank you.